Good morning, everyone. This is Vivian. Welcome to Phillip Securities Research Weekly Morning Call. For today, we have quite a few stock counter updates on the agenda. So firstly, there is Ascott Residence Trust, CapitaLand Investments, Manulife and Prime US REITs, and also results from Venture, NetLink, and further results for the three banks, DBS, UOB, OCBC, Phillip on the ground for Singapore Post, and we will also be doing a brief summary on the IPO by China Automotive before wrapping up with our usual Singapore Weekly. So without further ado, I'll now be passing the time on to Natalie for Ascott Residence Trust.
Thank you, Vivian. Good morning, everyone. Starting off with Ascott's third quarter business update. Okay, so this is a business update, and there were no financials provided in this operational update. To recap, the first half DPU was in line at 47% of our estimates. So on the positive side, we note that this is the fifth quarter of RevPAR recovery, as you can see from the graph on the right-hand side. Okay, so RevPAR grew by 8% quarter-on-quarter, driven by higher average daily room rates. Okay, and occupancy for the portfolio was unchanged at about 55%. So the stronger RevPAR was due to Japan, France, US, and UK. So for Japan, two of their service residences in Tokyo actually managed to secure group bookings for the Tokyo Olympics. And for France and UK, they benefited from domestic leisure, as well as some European leisure demand within the region. And in the US, there was strong leisure demand, particularly because of the summer holidays. Okay. Also worth noting is that for China, the RevPAR actually grew slightly, 3% on the same store basis, due to returning long stay corporate demand. This was so far 9 months ended 2021 has been a very fruitful acquisition and rebalancing period for Ascott. So year to November, Ascott has invested $491 million at an average EBITDA yield of 5%. So this the assets that they picked up, 3 rental housing assets in Japan, as well as 4 PBSAs, student accommodation assets in the US. These are all in the extended stay segment, and it actually increases the AUM for this segment to 11% from 5% previously as at December 2020. Okay, and so one of the benefits of having this exposure is that it provides income stability as well as a stable base of earnings due to the high occupancy at these kind of long stay assets, above 95% even during the COVID period. On the negative side, we note that actually recovery was not very even, not all that even. There were some countries that were lagging, especially Vietnam and Australia, where performance was marred by lockdowns. So in Australia, both of these countries actually experienced, they were impacted by the lockdowns. However, currently, they have begun easing restrictions as at late September. Another small positive is that 3 out of 14 of ART's Australian properties were actually booked by the government for isolation business. Okay. In terms of outlook, Ascott's 8 key markets, these countries are France, UK, US, Australia, China, Japan, Singapore, and Vietnam. The fully vaccinated rate is relatively high, 68 to 84%. For Vietnam, actually, on a country level, it is lower at 23%. But for the cities where Ascott has presence in, namely Ho Chi Minh City as well as Hanoi, vaccination rates are about 60 and 80% respectively. So this high vaccination rate actually points towards returning domestic travel, and hopefully, it will prompt the government to actually establish some travel lanes. Okay. Overall, we maintain our accumulate and our with the unchanged DDM target price of, sorry, the DDM target price is $1.19. Okay. Next slide, please. Moving on to CapitaLand Investment Limited. Next slide. This is their 3Q business update. Okay. So for CLI, they provided some of the revenue breakdown. So revenue is actually comprises two segments. First of all, the real estate investments, which comprises the investment property that they own, either on their books or through through joint ventures and associates, as well as their stakes in the listed REITs, and also fee-related income, which, as you can see, comprises three segments: fund management, property management, as well as lodging management. Okay, so for the fee-related revenue, that actually grew by 18%, and the growth actually came from the fund management as well as the lodging management. Okay. So on the positive side, we see that active capital recycling was actually the main driver for the growth in the fund management fees. So CapitaLand divested 12.3 billion worth of assets as at 10 months 2021 at a premium of about 13.5%. So this compares to the 3 billion that they actually managed to divest last year. It's a 4 times increase so far. And also the premium of 13.5% is higher than what they have been able to do in the last 3 to 5 years, which is around 10 to 11% premium. Overall, this capital recycling actually allowed CapitaLand to rebalance their portfolio into more new economy assets. So 78% of the divestments were actually integrated assets, meaning a combination of your office as well as your retail portfolio and sometimes even hospitality. Namely, it was the Raffles City China assets. And 5.3 billion of investments were made. New investments were made, and 69% of them were actually in new economy assets such as data centers, logistic assets, as well as business parks. CapitaLand also incepted 7 new private equity funds, raising 1.4 billion from third-party capital providers. So 5 of these funds were actually incepted in 3Q 2021. So overall, this capital recycling as well as new incepted funds actually grew. FMFRE stands for Fund Management Fee-Related Earnings by 34% due to higher transaction fees and divestment fees, etc. As well as funds under management, it grew by about 9% year on year. Okay. For the lodging segment, it shows recovery. So the third quarter RevPAR actually grew by about 12% and 33% quarter on quarter and year on year. Occupancy also improved year on year. It's currently now at 60%, up from 50% a year ago. This improvement in revenue, or rather RevPAR performance, has actually led to a 23.1% year-on-year growth in lodging fee income. Also adding to this growth in lodging fees were about 5,300 units that became operational during the year. On the negative side, we note that Malaysia retail is lagging recovery. So for the retail segment, it's actually broken out into 3 geographies, Singapore, China, as well as Malaysia. And we can see that tenant sales for Singapore and China actually grew by 13.8% and 14.3% on a 9-month basis year on year. And that compares to Malaysia, where tenant sales for the 9-month period actually fell by 15%. And also occupancy is also 10 percentage points lower. Yeah, and this is of course impacted by the prolonged period of movement control in Malaysia. In terms of outlook, CapitaLand is slightly more balance sheet heavy compared to some of the other real estate investment managers. Ratio is about 0.49 times compared to other peers of 0.25 to 0.3 times. And this is actually critical for CapitaLand because their private funds business is actually has a less established track record compared to its record as a manager of listed funds, meaning the REITs and business trusts. And so in order to CapitaLand is prepared to take up about 20% in equity stake in newly incepted private funds, just to show a bit of confidence as well as alignment of interest with third-party providers. Yeah. And this balance sheet also actually allows them to pick up assets opportunistically, allowing them to then seed and initiate new funds. So it's essential for the growth of their private equity fund management business. Also, CapitaLand is on track to hitting their 100 billion funds under management target by 2024, as well as 160,000 keys by 2023. No change in our accumulate rating as well as sum of the parts target price of $4. Next slide, please. Next, on to Manulife. This is their third quarter business update. No financials were provided for this business update. In terms of the positives, we see that there has been improving tenant sentiment. So about 9.7% of NLA has been signed year to date, and at reversions of positive 1.3%. This new leases for the third quarter actually formed 32.3%, and this compares to what it was for the first half of 2021, where new leases only formed 3.3%. So in general, you can see that this is a little bit of a more positive outlook in terms of or more confidence from the tenants. Okay. There was also slightly higher physical occupancy, and that should help lift car park income. So third quarter physical occupancy was about 30%, and this compares to the 11% and 15% that we were seeing in the first quarter and second quarter. Not to mention, because of the lack of movement control in the US, patrons were still able to go out and about, visiting the entertainment as well as fitness venues, and two of Manulife's assets are actually located opposite such entertainment and fitness venues, and the patrons from actually utilized Manulife's car parks. So therefore, that also helps to lift car park revenues. In terms of negatives, occupancy dipped slightly quarter on quarter, 91.7% to 90.9%. However, it still remains above market occupancy, and post quarter, the occupancy, it means after September 2021, occupancy was actually lifted to about 91.6%. So just minor occupancy fluctuations here. Gearing is slightly elevated at 42%. This was largely due to some of the valuation declines that was recorded throughout the pandemic, and tenant incentives, TIs for short, which are actually incentives provided to tenants upon the signing of new leases for them to do capital improvements within their space. That is usually financed by debt, and it might actually cause gearing to inch up slightly. Yeah. However, Manulife intends to lower gearing and plans to do so in conjunction with portfolio reconstitution, meaning as they buy and sell assets, they will then try to either raise additional equity or debt to then, equity to then pare down the debts. In terms of outlook, there are 6 points here that I listed down that are actually showing there are supporting factors for the green shoots that are appearing in the US office market: improving net effective rents due to lower tenant incentives, longer lease tenures signed, decline in subleasing, as well as significant improvement in transaction volumes. Lastly, of course, is the improving rental outlook for Manulife cities. Manulife also remains focused on trying to get greater exposure to new economy sectors such as tech and biomedical. They are trying to acquire assets with at least a yield of 6.5% to 7.5%. No change in our accumulate rating as well as our target price of 84 US cents. Next slide, please. On to Prime. This is their third quarter business update. In terms of revenue, it grew by 10.1%, and this was largely due to contributions from two newly acquired assets, Sorrento Towers as well as One Tower Center. And these two assets were acquired in July 2021. Okay, for the remaining of their existing assets, performance was relatively stable year on year. On the positive side, once again, strong leasing. In the third quarter of 2021, reversions were 19.2%, and this was an improvement over first quarter and second quarter reversions of 9.5% and 13.3% respectively. About 4.3% of NLA was signed in the third quarter. This is a record amount of leases signed ever since the pandemic hit. Is about 3.6 times higher quarter on quarter. And new leases form about 17.5% of leases signed in the third quarter. Overall, the portfolio still does seem to have potential for positive reversions. If you compare the in-place rents versus the market rents on an average basis for the portfolio, the in-place rents are actually, or rather the market rents are actually 7.5% higher than the in-place rents. Yeah, and this is because the growth in market rents for some of these assets has actually outpaced the scheduled rental escalations embedded in Prime's leases. In terms of negatives, there were two pre-terminations that were announced in the quarter. However, the pre-termination fees that are collected will likely cover rents until 4Q 2020. So one of the pre-terminations happened at Washington Central, and that actually resulted in an occupancy decline, 95.6% down to 80.6%. Another pre-termination is from WeWork, which actually is one of Prime's top 10 tenants, contributing 2.5% to CRI. There are security deposits in place for this WeWork lease that will cover rent until fourth quarter of 2020. Okay, so Prime is also currently in discussions with WeWork to kind of finalize this pre-termination fee and also a date for the return of space so that Prime can begin marketing to release this space. So there's upside because the rent actually covers for a significant period of into 2022. So that means that if Prime is able to lease out the space and hand over the space to another tenant in advance, then that will mean that they are basically earning a free rent for the whatever period that they managed to sign. Yeah. Okay. In terms of separately, there was also one non-renewal at Western Square Park, and this non-renewal is actually because this tenant was acquired by another company, and therefore it will be moving its operations to the acquirer's building. Yeah, so not related to COVID. Portfolio occupancy slipped slightly quarter on quarter from 91.7% to 91.4%. This was largely due to the pre-termination at One Washington Center, as mentioned earlier. In terms of outlook, Prime is adapting to earlier lease commencement dates. So because some of the larger users of space, they require longer timeframes for decision making, this actually means that by the time tenants actually make a leasing decision, they are actually in a hurry to occupy the space. So Prime is evaluating strategies to shorten this timeframe for tenants to move in. And we think this could involve Prime preempting tenant space configurations and speculatively reconfiguring vacant spaces ahead of lease conclusion. This is a strategy that has garnered much success for one of its peers. The peer is actually Keppel Pacifico. Also, we expect that more significant return to office will likely happen in the first quarter of 2021. So that means that it's a more delayed recovery in car park income. Okay. Overall, no change in our accumulated rating as well as a target price of 94 US cents. Prime is our top pick in the US office sector due to its greater tenant exposure to STEM and TAMI sectors, which are your new economy sectors. That's all for me. I'll now pass the time on to Glenn.
Thanks, Natalie. So for the banks, we'll start with DBS. DBS's third quarter 2021 earnings of 1.7 billion exceeded our forecast. This is mainly due to further reversal in general allowances. The 9-month 2021 earnings is at 83% of our FY full year 21 forecast. The third quarter 2021 DPS jumped 83% to 33 cents. Its NIM, however, fell 2 basis points to 1.43% as a result of lower market interest rates. But this was offset by loans growth of 2% to 405 billion. This led to net interest income increasing by 1% quarter on quarter. Fee income was up 2% quarter on quarter, with momentum sustained across most activities. And DBS's stabilizing asset quality led to a GP write-back of 138 million, bringing the 9-month GP write-back to 413 million. The SP fell to 68 million for the quarter due to a write-back for a non-performing loan. For the positives, the fee income grew 11% year-on-year as all fees rose by double digits from a year ago. Wealth management fees rose 16% year-on-year with high activity across a range of investment products. Transaction fees grew 18% year-on-year to a new high of 239 million from increases in cash management and trade finance. Card fees rose 13% year-on-year as consumer spending continued to recover towards pre-pandemic levels. Also, as mentioned earlier, the group's asset quality is stable and repayment by weaker exposures and credit upgrades resulted in further GP write-backs. It lowered full-year allowances to under 100 million, with credit costs likely to be under 20 basis points. We believe full-year allowances will come under this guidance because of the group's asset quality. And in light of its recent GP write-back, we cut total provisions for full year 2021 to 19 million from 309 million. Its loan growth of 9% year-on-year was led by non-trade corporate loans, with growth led by drawdowns in Singapore and Greater China. The housing and wealth management loan growth was sustained at the previous quarter's levels. However, these increases were offset by a 2 billion decline in trade loans from higher repayments. Management's guidance for full year 2021 loan growth remains unchanged at high single digit. For the negatives, the NIM decline of 2 basis points was a result of lower market interest rates as deposits grew 1% quarter-on-quarter to 489 billion. This drop in NIM moderated net interest income growth to 1% Q-on-Q. Management now expects full year 21 NIMs to fall at the lower end of its guided range of 145 to 150 basis points. For the outlook, despite economic uncertainties from Singapore's return to phase 2 alert, loans and transaction pipelines are expected to be strong. We lower the allowance estimates for full year 2021 and consequently our earnings for full year 21 rise by 3.9%. For loans under moratorium, it remains low at 0.5% of total loans, with no exposure in the rest of ASEAN, specifically Malaysia and Indonesia. SME and mortgage loans under moratorium in Singapore are down to around 100 million with no delinquencies. 80% of the ESG loans in Singapore are paying both interest and principal, with also no pickup in delinquencies. The group also has no exposure to real estate loans in mainland China. And with its capital position and liquidity well above regulatory requirements and high allowance reserves, we believe that the bank has sufficient provisions to ride out current economic uncertainties. The third quarter 21 DPS is 33 cents, back to pre-pandemic levels, and we do not rule out special dividends. The group has also mentioned that the 10 basis points rise in interest rates could raise profit before tax by 18 to 20 million. So assuming 2 rate hikes of about 50 basis points next year, our FY full year 22 profit before tax can climb about 1 billion or 14%. As such, we maintain our accumulate rating with a higher target price of $35.90 from $32. Now moving on to UOB. UOB's third quarter 21 earnings of 1.05 billion was in line with our estimate, and the 9-month 21 earnings is at 73% of our full year 21 forecast. Jumping into the positives, their loans grew 3%, and this was underpinned by large corporate loans. NIMs, however, eased 1 basis point to 1.55% as excess liquidity has driven up competition for higher quality loans, especially in the financial institutions group space. However, this lower NIMs was offset by fee income and thereby more attractive return on risk-weighted assets. Guidance of stable NIM for full year 21 remains unchanged. For the fee and commission income, it grew 15% year-on-year, and this is particularly from wealth and loan-related fees as investment and trade activities pick up. Fees, however, were 1% weaker quarter-on-quarter as loan-related fees moderated after a record second quarter 2021. Allowances were stable at 20 basis points, and it was at 163 million in third quarter 21 versus 182 million in second quarter. This quarter-on-quarter drop reflected overall resilient asset quality and strong preemptive general allowances taken previously. The total general allowance for loans, including RRARs, were prudently maintained at 1% of performing loans. For the negatives, the loans under moratorium lowered to 4.8%, which we still believe belong to weaker corporates, which still require loan relief. And as these moratoriums begin to expire, we could see an uptick in the NPLs in the remainder of full year 21. With the Malaysian government announcement of a blanket 6-month moratorium until early 22, the government management expects an increase in NPLs among consumers and SMEs in Malaysia, with management expecting an uptick in the NPL ratio to about 1.7 to 1.8%. Around mid-20% of Malaysia's loans are under loan relief, or this represents around 7 billion, and the management has estimated that the impact of the interest waiver scheme in Malaysia to be marginal at less than 10 million. For the outlook, UOB's profit should recover in 2022 on the back of stabilizing margins, stronger fees, and lower provisions. We expect wealth management, loan-related, and card fees to continue to expand, and we continue to expect credit costs to come in below the guidance of 25 basis points. There's also earnings upside from write-backs of the $1 billion in management overlay of general provisions. However, a condition to this write-back will be the outlook of the pandemic. UOB's exposure to mainland China remains at 6% of total assets, with bank exposure at 10.7 billion and non-bank exposure at 11.9 billion. Nonetheless, customers include many domestic and policy banks, top-tier SOEs, large local corporates, and foreign investment enterprises. The NPL ratio for non-bank mainland China remains at 0.3%. Lastly, management only expects improvement in the NIMs in the later part of 2022. Asset quality is expected to stabilize, and management expects to continue to see strong demand for loans as cross-border activities pick up. ASEAN loan growth are expected to be higher, with some slowdown in Singapore and North Asia. The growth so far has been skewed towards the developed markets as the ASEAN economy remains muted, but management expects this to change in 2022 as the economy recovers. As such, we maintain our accumulate with an unchanged target price of $29. Now moving on to OCBC. So for OCBC, the third quarter 21 earnings of 1.22 billion is in line with our estimate, and the 9-month 21 PATMI is at 80% of our forecast on lower than expected allowances. For the positives, the fee and commission income grew 14% year-on-year and 1% quarter-on-quarter, and this was particularly from the wealth management income, which makes up 35% or 897 million of the group's income in the third quarter 21. However, the group's asset under management, the AUM, fell to 123 billion, matching the first quarter of this year. And this was mainly due to the decline in market valuations, which offset net new money inflows. OCBC was also able to write back GPs of 22 million during the quarter as the credit environment improved, while SPs of 185 million were made. Total NPAs rose by 4% quarter-on-quarter to 4.2 billion, and this was mostly attributed to downgrades of secured consumer loans in Malaysia. Nonetheless, OCBC has set aside 185 million of SPs this quarter, mainly for these corporate and consumer accounts in Malaysia and Indonesia. The group NPLs were stable at 1.5% in third quarter. The negatives, the NIM declined by 6 basis points quarter-on-quarter, and this was mainly due to the classification of loans to NPL mentioned earlier, and more competitive corporate loans, which resulted in lower asset yields. As such, management expects NIM to maintain at this 1.5 to 1.52% level until first half 2022. Nonetheless, the NII grew 3% year-on-year and remained flat quarter-on-quarter. This was underpinned by loans growth of 4% quarter-on-quarter and 6% year-on-year, and which was backed by demand from Greater China, Singapore, and the UK. Loan growth this quarter was led by higher loans to the building and construction sector. For its loans under moratorium, it remained unchanged at 2% of the total. And this portfolio of relief loans, however, increased to 6.3 billion in the third quarter from 4.5 billion in the previous quarter. The increase was due to an increase in Malaysia's relief loans to 4 billion in third quarter compared to 1.5 billion in the second quarter. This represents 19% of the bank's Malaysia's total loans. Nonetheless, management has mentioned that the majority of loans under moratorium are performing loans, with all loans under moratorium in Singapore performing, and about 20% of Malaysia's loans under moratorium non-performing. Management expects the non-performing loans under moratorium to drop with the improving economic situation. The 89% of all loans under moratorium remain secure. For the outlook, loans growth of 6% year-on-year is trailing the bank's guidance of a high single-digit increase for full year 21. Management, however, believes its target is achievable. It sees lending opportunities in the wholesale segment and sustainable financing. Their green and sustainable finance was up 12% quarter-on-quarter to 19.5 billion, and now this forms 7% of its loan book. The mortgage pipelines in Singapore and Hong Kong are also healthy, with drawdowns expected in second half 2021. OCBC's total exposure to mainland China also remains at 11% of group's loans, with onshore exposure at 6 billion and offshore exposure at 26 billion. Nonetheless, customers include many top state-owned enterprises, large local corporates, as well as OCBC's network customers. Less than 1/3 of the group's mainland China onshore exposure, around 2 billion, are corporate real estate loans. largely lending to the bank's network customer. The NPL for non-bank mainland China loans dipped to 0.3% from 0.5% in the previous quarter. The non-performing assets has risen due to new NPA formation, mainly from the downgrades of secured consumer loans in Malaysia. And however, this was offset by recoveries and upgrades of mainly corporate accounts in the oil and gas support vessels and services sector. We expect the loans under relief to nudge higher as the COVID situation recovers gradually in Malaysia and Indonesia. And in anticipation of this, the management has set aside 185 million of SPs this quarter, mainly for this aforementioned corporate and consumer accounts in Malaysia and Indonesia. As such, we maintain a buy with an unchanged target price of $14.22. Okay, that's all for the banks. I'll now hand over to Vivian.
Thanks, Glenn. So this will be a brief summary on the upcoming IPO by China Automotive Holdings, or TCA for short. So TCA has lodged their prospectus to list on the Catalyst last Monday on 1st of November. They are offering a total of 85 million shares, and this consists of 82.1 million placement and 2.9 million public shares. The total of 85 million shares is about 14.6% of the enlarged share capital of 584 million shares. So with the offer price of 23 Singapore cents per share, the total market cap upon listing will be about 134.4 million Sing dollars. So they are planning to raise a total of 16.3 million Sing dollars, and the purpose of funds include 67% of the majority to increasing the number of dealerships, showrooms, and service centers in various cities in China. A few key dates. So the public offer has started. It will be closing tomorrow on the 9th of November at 12 noon, and they will be commencing trading on a ready basis this Thursday on 11th of November at 9 a.m. So a summary of what they do. TCA is basically a car dealer. They are the authorized 4S and 5S dealers for focusing on the distribution of premium and ultra-premium automobiles in China, including BMW, and they also have 4 McLaren showrooms and 1 Lotus showroom. Being a key player in the Greater Bay Area, their showrooms are located in the Tier 1 metropolitan cities like Guangzhou, Shenzhen, Chongqing, etc. You could refer to the pie chart in the middle for their business segments. So firstly, there is the new automobile sales, which make up bulk of the revenue. And secondly, they also do pre-owned automobile sales. This is mainly from customer trade-ins. Thirdly would be the agency services, such as referrals for financing and insurance services, where they receive referral fees. And lastly, which is also the main driver of profitability, they provide after-sales services, including the scheduled servicing and repairs. A few investment merits as provided by TCA. So firstly, they have established a strategic presence in key automobile markets in China, so as mentioned in the Greater Bay Area. And in 2020, TCA averaged about almost twice of the national average of automobile sales of units per store. Secondly would be the high earnings visibility driven by the after-sales services business. So as mentioned, this is the main driver of profitability. And they measure this through this metric called high absorption ratio, which is defined as the ratio of after-sales service gross profits to the operating cost. So you can refer to the chart on the bottom for a summary of the absorption ratio for their stores compared to the listed competitors. So take, for example, the BM store in Foshan. The after-sales service gross profit is about 1.72 times of the operating cost. And this is also partly achieved through higher than average after-sales ticket size, as seen in the graph on the middle, in the middle on the right. So this compares the average after-sales ticket size for the BMW stores to the other brands, and possibly achieved through, of course, higher quality and also value-added services. But of course, a fairer metric would be comparing this average after-sales ticket size to the ticket sizes in the cities where they are present in. Thirdly would be BMW's expected strong growth in China. So why they mentioned this is also partly due to the fact that about 90% of the revenue is contributed under the BM brand. So two revenue drivers here. Firstly, the premium segment in China is expected to grow at a CAGR of 10% over the period of 2020 to 2025 versus the mass market growth of 3.5%. Secondly, would be the full range of EV models to be launched by 2025. Last investment merit would be future growth opportunities in the form of growing the new dealerships to other brands other than existing ones, and also into other regions in China. So looking quickly at some of their financials. So as you can see from the top left graph, revenue by brand, BMW makes up about 94% of the total revenue, and this includes sales of automobiles and after-sales services. If you look at the next graph, this is the revenue by segment. The sales of automobiles make up around 88% of the revenue. And the top line growth has been quite healthy as shown in the yellow bars. And the increase for first quarter of 2021 was attributed to a recovery from the pandemic, resulting in a higher demand for after-sales services and also higher sales of automobiles. Next, if we look at the gross profit line, so you can see that the segmentation is basically a reversal of the revenue segmentation. The provision of after-sales services contributed around 66% of the total revenue. So you could also see this as the sales of automobiles bringing in this after-sales services. And on the gross profit margin, it has been at about 7.5% to 7.6% over the last 2 years. Yep, so that's all for TCA. I'll now be passing the time on to Paul for NetLink.
Thanks, Vivian. I'll move on to NetLink's first half results. Title Some Growth Returning. You know, this company is supposed to be flat, but there's a little bit of growth at least for the first half of this year. Next slide. So for NetLink, just on the results itself, the first half revenue and EBITDA was within expectations. The DPU just grew a modest, I think 1%, and hardly changed for the DPU. You can see on the table here. In terms of the positives, the normalized EBITDA is a bit complicated here, but because they made this one-off receivable remeasurement loss. It's a bit complicated. They have this long-term lease with Singtel, and then the rates have come down lower. So there's this, like, you can think of it like a revaluation loss. And once you exclude that, and you exclude the government grants and rebates in last year, the normalized EBITDA actually grew 3%. A lot of it came from diversion and co-location. As you know, last year, because of the circuit breaker, there was no work, and nobody could install anything, or a lot of the road works and so forth. In terms of the second positives, you can see that the finance cost was down, and that's because they kind of lowered the borrowing cost to 1.1%. So the table on the left just shows the EBITDA is on the normalized is up 3%. Just that because of the one-off, the headline shows the 9% decline. The negatives, as per the negative, I think the last 2-3 quarters has been there's no new residential connections. I think with the slowdown in HDB construction of new units, BTO units, I guess there were only 3,000, almost 4,000 connections for first half of this year. We were modeling always 25,000 per year. So you can see how far off we are from what they are trending now. But in a way, these connections are not that material per se, because they have 1.4 million base. So we're talking about 1%, 2% kind of growth. So it won't move the needle, but it just impacts the growth profile to a small extent. In terms of the outlook, it will be a recovery year this year because of the rebound in installation. I think the curious thing is, like, why is there installation revenue when we just said that residential is so slow? But the residential revenue comes from the so-called NBN, which is 5G installations. They install fiber connections to lamp posts and so forth. So that's where they're getting the installation revenue. A diversion is, sometimes I guess they are the ones that are always blocking causing the road traffic congestion on that, because they have to divert some of the lines and so forth. So that's what we mean by diversion. So in terms of outlook, there is still some lingering impact from the pandemic because of the home construction. But do know that we think dividends can maintain, because what they're doing is they are spending a lot of capex, and this is not a typical REIT. So this is a business trust. So for business trust, how they calculate DPU or distributor income is they actually deduct capital expenditure. So long as they're investing in a way, we are kind of like this, like pure free cash flow, which includes capex. So they're taking out some of their investments, future investments, and paying less dividends because their capex actually rose. So if they actually want to raise dividends, they can just cut back a bit of capital expenditure. So we think the DPU can actually sustain even in the next regulatory review. So we maintain a cumulative target price of $1. So this is the typical stable assets that can pay you like a 5% dividend yield, because they're collecting monthly recurring income from 2 million from all of us, I guess, fiber connections from homes and businesses. Next slide. Venture. So it's a disrupted quarter. So this year the numbers was disappointing because of all the EMCO in Malaysia and so forth. Next slide. So in terms of the results was below expectations. The PATMI fell, and the PATMI was only like 60% rather than annualized 70+%. Just a reminder, there is no briefing, no update. The only financials they see is what you get on the table here. In terms of the income statement, they did give you revenue, PBT, and that's it for all of us. So in terms of the positives, the margins was up 10 as per previous quarter, and the balance sheet is as strong as it's still at 853 million. And this was despite a big spike in inventory. There was a big jump in inventory, I guess, in view of the component shortages. The negatives is just the revenue. It's just still running short. Pre-pandemic, Venture was revenue run rate. It means the quarterly revenue was about 900 million. So you can see that it continues to drop, and now it's trending about 700 million past this year. So what we think is they are still, for this quarter was affected, of course, because of component shortages and also the EMCO in Malaysia, which basically shut down the factory. So what they're saying is that we think that because they're pivoting to line science, it takes some time for manufacturing, because these are new products, so it takes some time for mass production. In terms of our outlook, we cut our forecast. The company said that this is their words, demand is healthy and broad-based for what it's worth. But we think the worst of the disruption should be over, because their Malaysian workforce is fully vaccinated. So in Malaysia, you're fully vaccinated, then you can run as much as according to how much you vaccinate, I guess. So manufacturing activity should resume, and we think fourth quarter should be better. We are expecting like an 11% growth for fourth quarter. No change in our target price. We are rolling into FY22, mainly because it's a bit more normalized here, because this year, there's a lot of disruption. And no change in our target price. This company pays 4% yield, and hopefully you get, again, as usual, you get paid 4%, as we hope that the turnaround happens when all their new life science products, start to ramp up. Next slide. Okay, I'll run through our usual weekly. In terms of the data points from Singapore, retail sales was a positive. At least we're starting to turn around the corner. September was 8% up. Supermarket, although this is a bit historical because Sheng Siong's results is already out, but it's worth noting that supermarket sales is up 4%. And when you compare it to pre-pandemic, I think year on year is up almost 20%, if I'm not mistaken. So if you compare it, September September month versus 2019 is actually up almost 20%. So you can see how elevated supermarket sales is. In terms of dental, we also got data of the industry outpatient admissions, basically the number of patients. So what happens is that September was a bit flat. We think it's because of the knockdowns and so forth. But for the quarter, it is up 16%. So this should fare well. So it should be another quarter of growth for Q&M, because if the industry is growing 6%, and we think they're taking market share, so they should be able to outgrow this 16%. In terms of, these are some manufacturing data. I think it's basically manufacturing activity is stable in a nutshell. A lot of data from the US, I think most of us would already have heard, but let me just run through again. There was employment numbers. I think it 500, it beat expectations. And the other thing to note is also which growth is accelerating. I will show you a chart later. I think the FOMC basically this is undergoing tapering. But when you watch some of the keywords mentioned by Powell, again, they still want to reach this maximum employment. And what they think is inflation is not due to the tight labor market. I mean, good luck to that, but that's what they think. The other positive was the infrastructure stimulus, but again, this is over 8 years, so the impact per year may not be that significant to the US economy. In terms of our technical views, we are still positive. I think the path to endemic COVID is clearer now with the antiviral drugs and with the young getting vaccinated. So we still think the reopening play in stocks should continue, like what Natalie mentioned, like Ascott and so forth. We think there's upside risk in interest rates. I think the message you're getting basically, we think at least, is that the Fed is willing to tolerate higher inflation since employment is their goal, so inflation also important, I guess. So we think inflation could still run hot and higher than their expectations. So there's there's upside risk to interest rates. In terms of the weeks ahead, not much key events, but I guess the important one is today. That's when the US borders open to vaccinated travel. In terms of our Poland's webinar, tomorrow we have 2 in one day, so sorry if it inconveniences anyone, but we have one at 3 p.m. and one at 5 p.m. straight trading, and these are the last few for the year. So after that, we will end it by the 15th of December. So if you are interested, feel free to just register. Thanks. Next slide. Again, just a run through. This is just the global cases, but I think the important thing I guess is that so long as the cases don't spike up to some new high, I think the path towards reopening persists. I think that like many countries, as we read almost every day, have some reopening measures. So long as the table on the left, you don't see some huge spike, I think then we should not be worried, I presume. And also, even in UK, the spike in cases, but they don't seem to be like going back on any of their lockdown measures. Next slide. This is for Singapore. I mean, just for your reference, I guess the speculation right now is that the so-called weekly infection rate is below 1. But again, these numbers are so volatile, so I'm not sure how much we can read to it. Yeah. Next slide. Okay, this is the healthcare data. So the table on the left is private hospitals. I think ultimately this is a Thomson Medical, Raffles Medical chart, I guess. So you can see the latest number, admissions. I think it's September. Yeah, September, the table on the right, it is lower year on year compared to 2020. But when you compare, it is down 0.6 year on year. That means compared to a year ago. But when you compare to pre-pandemic, it's still about 20% below pre-pandemic. And I guess this kind of fits nicely to foreign medical tourists is roughly around 20% of revenue, although may not be admissions, but at least for 20% revenue. So maybe the difference is because the borders are closed. So without the medical tourism filling up that 20%, it will still be lower than the pre-pandemic levels. The table on the right is just industry dental admissions. So this one is a bit different chart. So we do like the red line is 2020 for the month. So what we're watching for is the blue line, which is 2021. So long as it is higher than the red line, that means there's some growth. Right now, it seems to be flat, but we kind of think maybe it's also because of the lockdown measures. Maybe the attendance may have kind of come off. But more important for the third quarter, at least it's still up 16%. So there should be some growth in the dental revenue. Next slide. This is just a reference, but even though job growth is improved, we are still like 4 million below pandemic levels. And the one on the right is just to show you the growth rate, how elevated wage growth is, which will be another pressure point for inflation. So if you look at the 2019 or 2018, you can see wage growth in the US trending around 3% pre-pandemic. Avoid those big gyrations, because there's a bit of anomaly there. But if you're trending at 5%, now it's 50% above pre-pandemic level. So this will be another pressure point for inflation. Next slide. Okay, this is my second last slide. This is just because the Fed is officially gone into tapering mode. So we wanted to just have a quick look at how interest rate expectations. The table on the left is just a forecast. So I mean, like it's probably like my forecast are not very accurate. But anyway, the forecast for year end is 2% for the 10-year bonds. But the one more important one is on the right, because that's where the investors in the futures market actually are betting on. So the market expects at least 2 rate hikes in 2022 by December. So how you read this chart is that the number of hikes is red, but it's a bit confusing. Sorry, but the blue bar means the expectations is a 0.53%. Sorry, the red line. Sorry, the red line is 0.53%. Means they're expecting a Fed funds rate, from roughly 0, not totally 0, but from roughly 0 to 0.5. So this implies 2 rate hikes for December 22. So of course, if this really happens, then it'll be very very positive for the banks, especially like DBS. Next slide. Okay, this is my last one. Just to share with everyone, because I know not many get to attend the SingPost, especially on the Q&A part. But this is the SingPost first half results, actually not update, but you can see that there's a rebound in SingPost numbers on the table on the right, from 40 to 51. What has done well is the logistics from 5.7 to 16, and what has collapsed is the post and parcel, which I'll explain. I think we all know what Singtel is now, but anyway, the other thing that Singtel, apart from Singapore, the biggest market is Australia, where they are building out a lot of logistic and freight operations in Australia. So for SingPost, in terms of the post and parcel, you can break it up into 3 parts. There's domestic mail. I think we all know it's just get all the letters and so forth. So that is still down, and that is structurally challenged. It will continue to come down. But the positive is that the e-commerce, which is all the Q10 deliveries, I guess, it is up 45% year on year. And what is eventful now is that as a result of the growth in e-commerce, it kind of offsets the weakness in mail. So we are it's kind of a bit of an inflection point, because at least the domestic post and parcel cannot trend sideways or hopefully even grow, because right now domestic e-commerce is now so much larger and growing so much faster. What has hurt them the most is international mail. So for those who don't know, actually what SingPost does is they will take mail from China, and then from China send to Europe. I mean, you're asking why don't go direct, but because we have a hub here and it's better rates here, we are a bit more competitive. So that business did very badly because Changi was an excellent hub. I think one of the best around. That in Changi you can fly to 200 countries within 1 day or 1.5 days. Of course, with the pandemic, this is lost. So this competitive edge is lost. Now instead of 1 day, you're lucky you get it in 7 days. So as a result of this, they took on less mail, because if you take on this mail and then you don't deliver, you're going to get heavy penalties. So there's one other, I guess that's the other part of the closure of Changi, which probably not so evident for everyone. But if this opens, of course, then they can restart the international mail business, which is huge. I mean, you can see there's 200 million. Logistics did well in Australia. I'm not sure why, but I think freight forwarding did exceptionally well. The earnings tripled. My guess is that they probably got higher volumes and pricing, because there's such a shortage of container space, I guess. Nothing much. The second point, second last is just that Australia is the main point. In terms of outlook, for us, I think the bigger structural change for them is that they need to improve the e-commerce delivery, because our mailbox is not meant to deliver big parcels. So the infrastructure such as smart letterbox will be a very key initiative, because this will kind of improve efficiency and so forth. Yeah, I think I won't do the rest. I think in view of time, I think I just go to Q&A. Yeah, thanks. I think we can head on to Q&A. Yeah, thanks.
Okay, so thanks, Paul. So I'll start along with the Q&A. Just allow me to share some screen first, based on the number of questions that's being asked. So we have quite a number of counters. So allow me to go through some of them. So first of all, I'll start on with the Hang Seng Tech Index, Lion OCBC, the ETF. So first of all, I think the falling wedge has really been broken out. Support remain at 0.087 to 1.023. So this region has been tested twice. Initially, there was a double bottom all right, in the another, the iShares one is head and shoulder. But right now, I think what is in common for the Hang Seng Tech is there's a possible triple bottom formation. So I expect expect price to actually retest the lower boundary of the support zone, break up, and then test over the midterm. It's going to test $1.24 to $1.277 over the midterm. However, to take note that the trend is still on the downside. It has already closed below the 50-day moving average. So technically, we are still on the downside trend within a ranging kind of target. So hence, the only hope that we have is 0.097 to 1.023 remains supported. Do take note that the ADX is showing a slope down, means that trend momentum is kind of like weakening for the moment. Okay. Moving on to the China CapitaLand China Trust. So for CapitaLand China Trust, we have a smaller falling wedge, Adam and Eve kind of like double bottom. So this is Adam bottom, this is Eve bottom. Is kind of like very well supported at $1.20. Furthermore, if you zoom in, there's like a potential tweezer bottom. So if price managed to stay elevated above $1.20, support close with like a bullish upper body, a shaven top, then we will expect some price to break up above $1.22. And what should price break off the $1.22, we can see the longer term target to $1.36 in the longer time period. All right, but I would like to point you to the attention that we do have remained a bearish depth cross. So looking at Ichimoku as well, price has actually trend below, has a renewed bearish crossover. The lagging span is below the trend, and Senko span A has a renewed downside as well. So typically, if we bring on the upside, well, we are taking a risk right now. Should price fails to break above $1.25, then we can see that the major support rebound will be at $1.08 to $1.12 in the foreseeable near future. Ascott has been relatively performing well ever since the rounding bottom has filled out the gap. Not only that, he has a bullish outbreak on 1st of November last week, and price has ever since stays above the $1 psychological resistance level. Not only that, $1.05 immediate resistance level has been breached. So we are seeing this larger ascending triangle going to break to the upside. Should it breaks, then we can see that the foreseeable future, the target will be at $1.28 to $1.31 in the near future. All right. Okay, so next one will be Yang Zijiang. Yang Zijiang, my view remain the same, bearish sell down. Ichimoku is on the downside, especially it has a bearish gap, bearish runaway gap after it breaks off the bearish this channel, aka the bearish flag. All right, so price is likely to find some support, the major support at $1.08 to $1.14 in the foreseeable near future. And as I mentioned before, the Elliott wave 1, 2, 3, 4, 5, fifth wave has been completed. This is like the larger wave 3. So we are seeing some more downside going on forward. All right. For ST Engineering, I would like to point your attention to the weekly chart. So the weekly chart, we can see that it has been consolidating since 07 last 07 with a upside in 2013. That was the last high that it has. So after that, there was like bout of ranging around. So I would say that from the longer time frame, we can see that $4.50 is likely the upside target for now. Last year it drops, and then if it has a great sell-off, so price has been climbing up successfully. But this ranging box tell us that we are looking at preferably a support at $3.60 before a rebound to the upside. No doubt the resistance zone has been tested multiple times, offering signs of weakening in the process, but I doubt that it will in the near term will breaks up anytime soon. So I will think that $3.60 is a viable support to buy back on the rebound to aim for the upside. Looking at the daily chart, price has already came down. This may be a bearish dark cloud cover, so we are looking at a preferably break below $3.70, target $3.60 before the upside target. All in all, ST Engineering is on the ranging as displayed by the Ichimoku Kinko Kyo. Next one will be CapitaLand Intercom Trust. Last week or 2 weeks ago, the ascending triangle has been broken up on the upside. Today, it hit a target of $2.20. So there's some sort of like intraday selling based on the hourly chart. Price seems to have rebounded for now before it closed for lunch trading. So, but you can see that the $2.20 level has been like tested multiple times with this zone as well. So I guess there is a possibility that a price is going to hit up, breaks $2.22, $2.26, aim for upside at $2.34 in the midterm. So let's look at it. Looking at the weekly chart, there's a false breakout double bottom, right above the support at $1.91 to $1.95. And then if this breaks, then we'll look at the $2.34 that we mentioned earlier on as a midterm target. Okay. So next one is Mapletree Industrial Trust. Bearish downtrend, bearish flag has been confirmed after it breaks off the lower bound at $2.72, especially today it closed below the Tenkan Sen. If this candle is going to maintain this way, bearish candle, we are looking for rebound at $2.50 to $2.55 region. All right, or the lowest is $2.50. All right, so we are looking for a rebound over here. Basically, it confirms the bearish downside for Mapletree Industrial Trust. Someone asked about Hong Kong Land, so I'm going to bring you to the weekly chart. Hong Kong Land has been on the on the downtrend since 25th May. Lower low, lower high, lower low, lower high, lower low. So right now we are going up on the uptrend right now, intermediate uptrend. So price is likely to maintain a consolidation around 586 to $6.11 resistance zone. So we can see some of like a little more upside to it. So the upside, we have there may be a pullback to $5.50 to $5.45 if there's like a strong sell-off. This support level that I mentioned, 545 to 550, will offer a very good support going forward. Jardine Matheson Holdings price is on the upside after breaking off the downtrend, intermediate downtrend line, but we can see that some shooting star bearish candle testing the upper resistance of the downtrend line, the primary downtrend line. So price need to stay elevated above $58.03 to remain supported. Okay, the lowest it can go is actually 55.14, which is a 50% retracement level. Okay, so these two levels are the rebound zone that I'm looking at. Overall, looking at the weekly chart, we are looking at the uptrend, targeting 69.13 in the longer term. Goal is not okay. So I'm moving out to the Hong Kong market. So the Hong Kong market, I did issue a report on Hong Kong Exchange, but there's a thread of the descending triangle. Support over here at 4454.4 and to 439.4 is like threatening to break down. Okay, likely we're going to see 405 or 421 as a support that we are looking at for a rebound. Okay. I'm sorry, over here 397 or 400. Okay, so 397 to 421 are the region that we are looking for a rebound to the upside. Okay, all right. So and furthermore, this pennant larger symmetrical triangle, likely it is broken down. It might turn into a flag, like a corrective channel. SMIC descending triangle support are likely to range for a while. Major support remains at $16 to $17.75. My view remain unchanged for the past 2 months. Okay. Lastly, CNOOC, the oil counter, price not really that fantastic, has been ranging, failed ascending triangle in June, return back, and then price fails to break sustained closure above $9. Hence, remain that a long-term rebound is going to be at $6.24 to $6.67 in the foreseeable future. All right, so that's all for me. I'm going to pass my time back to my colleagues for further other questions. Thank you.
Natalie, you want to go ahead first before handing over to Glenn? Thanks.
Hi. Okay, sorry. Okay. I'll take some of the questions. Give me a second. Okay, for Dasin Retail Trust, following the 70% sale to Sino-Ocean. Yes, okay. For Dasin Retail Trust, following the 70% sale to Sino-Ocean and the appointment of Dr. Kong Wei Ping, the share price spiked but closed with small gains on 13th of October. A change in the management but not the trust ownership. What is the next milestone and the final outcome? And will the final outcome result in a better capital management? Okay, so for this 70% sale in the trustee manager, it is actually in conjunction with the issuance of a 1-year call option on the ordinary shares. That means the chairman, or rather the former chairman, will then sell his stake of shares to Sino-Ocean, thereby increasing Sino-Ocean's stake from currently it's about 6-7% to up to 30%. That means not more than 30%. Yeah. So eventually, I guess this is just the first step, and of course, if we hope that it will be Sino-Ocean will exercise the call, and then buy over the shares. Of course, as a recap, Sino-Ocean is actually linked to a SEO, and two of their investors are actually large life insurance companies in China. Okay, and hopefully, because Dasin is currently in the midst of trying to renegotiate some of their refinancing, they have had some hiccups along the way. Therefore leading to extensions instead of refinancing, and this is because partly because of the instability in the shareholding. So initially the renegotiation with the lenders was stalled and then had to be restarted when they tried to introduce ARA as an asset manager, or rather as an investor. And then after that, now with this Sino-Ocean, but we are progressing further along with the Sino-Ocean deal, and I think, of course, as that deal progresses, the likelihood of refinancing and hopefully refinancing on better terms will slowly take shape. Yeah. Okay. So another question targeted at Paul, but I will take it. It's on also Dasin Retail Trust, and is it a good buy now given the low PB, and what are the chances that it will become another Eagle Hospitality Trust? So for Dasin, actually one of the risk factors is that all of their loans are actually on secured basis, meaning to say that the properties are actually mortgaged to the bank, or rather used as collateral against their loans. So if, let's say, they are unable to secure any refinancing for the loans, the bank which now holds the collateral for the asset, or the deed for the asset, can then liquidate the asset to repay this loan. So that is in a very, very dire situation. And if things ever get to that state, because the assets are still located in the Greater Bay Area generating revenue, who is to say that the Sino-Ocean, which is their incoming hopefully one of the majority shareholders, will not step up with an intercompany loan. So I mean, whether or not it will become enter liquidation. There's always a possibility for any firm, any company, but hopefully it doesn't go that way. But that being said, there is this risk that because the assets being 100% on secured loans. Yeah. Okay. Okay, I'll take some other questions first. CRI. Do you think that CRI is a good buy when dividends is only 2.4%, which is lower than the CPF rate, especially when share upside may take a while to realize? So first of all, CRI is not a dividend stock. It will be unfair to compare it based on the dividend yield. If you look at all the other developers, although CLI right now is trying to position itself as a REIM, real estate investment manager, rather than a developer, the dividend yield for developers are also around 2-3%. Okay, so that being said, based currently CapitaLand and now transitioning to CLI, their dividend payout ratio has always been 30% of cash PATMI. And as CapitaLand Investment Limited actually transitions more to an asset-light model, meaning to say that higher percentage of recurring fee income, etc., and therefore a higher proportion of cash PATMI, the management will consider reviewing this dividend payout policy. And presently, even currently, this year it has been a very good, fruitful year of capital recycling for CLI. However, they will not review this dividend policy as yet because they want to wait for the COVID period or any risk from the COVID re-outbreaks or new waves to be behind them before they then consider a review of this dividend policy. So for CapitaLand investment, some of the growth drivers for this company also includes the growth in their funds under management, as well as lodging management revenue, the fee that is charged for the lodging management, which 46% of the keys that have been signed are actually not yet operational. So once these keys actually come online, then they will begin generating revenue. So as an estimate, the company has guided that for every 25,000 keys, for every 10,000 keys, it will generate about 25 million, I think, on a stabilized basis per year. Yes. So that means that there's more upside potential for the earnings. Okay, next question would be with regards to Ascott Residence Trust, do you have a revenue breakdown in terms of ratio of business travelers and leisure travelers? So for the assets that are under management contract, that means not on master leases, the ratio of leisure and business travelers is roughly about 50-50, be it pre-pandemic or currently. But of course, in the past few months where some areas were actually there was still movement control in some of the areas, then the Ascott, or rather the manager, did see a higher percentage of leisure traveler, corporate travelers. Yeah. The next question, Manulife US REIT is in US dollar. Is there forecast for US SGD for 1 year time frame? Oh no, sorry, we don't have this forecast. Generally, we actually look at the Bloomberg consensus forecast as a guide. There's another question on CLI, which is what are the investments in new economy assets? I mentioned earlier the 65% of 5.3 billion, and what are the divestments in the integrated assets? So for CLI, the assets that were acquired new economy, those include, give me a second, data centers, the Shanghai data centers, about 700 million worth of them, 100 million in logistic assets, as well as 100 million in business park in Dalian. Yeah, I think there's also others. I can share the screen. It is a complete list of their investments and divestments that is actually available as part of their 3Q outlook. Okay, and for the divestments in the integrated assets, this is actually the largest chunk of the divestments. These are the stakes in 6 of CLI's Raffles City China assets. So they have several, spanning from Shanghai to Channing, etc. So there's the 6. They didn't divest the entire asset, although although the assets are actually in private funds, so they're actually divesting the stake in the private funds. Yeah. Okay. The next question would be CapitaLand fee-related revenue, 655.7 million, comprises of what fee? Can you elaborate? Can you, sorry, Vivian, can you bring back the slides to the CapitaLand one? Meanwhile, I'll answer the question on what is STEM and TEMI. So for STEM and TEMI, okay, so for STEM and TEMI, actually, it refers, the acronym actually refers to science, technology, engineering, mathematics, as well as TEMI stands for technology, advertising, and media, infocom. So these are, so these are all like growth sectors or new economy sectors which are experiencing this growth, and therefore they are able to or more willing to pay for pay better rents compared to some of the sectors that are actually downsizing, which are more of a traditional office users like your banks, your legal kind of tenants. They are actually downsizing. Okay, thank you, Vivian, for the slide on CLI. So as you can see, the fee income actually is broken down into 3 parts here: fund management, property management, and lodging management. In my earlier initiation on CapitaLand investment, the report is dated 18 October. I actually gave an outline on what these sectors are and how they contribute to income. So for example, the fee income business, the fund management business, they generate this fee whenever they, from first of all, of course, managing the AUM, and it is a percentage of the AUM that they manage. And also, of course, they earn fees when they are able to recycle assets. That means divestment fee, acquisition fee, some of them performance fee, as well as, in future, as CapitaLand originates more funds, they're going to try to include the element of carry or promote fees. Yeah, which is basically another way of saying performance fees. Okay. Then for example, your property management is also AUM based. So it means the more AUM they manage, the more fees they can generate from this management of the AUM, property management fees. Then for the lodging management, it is based on the key driver is basically the number of keys under management, which right now they're trying to move towards an asset-light model, or rather they currently have an asset-light model. 80% of the keys are actually third-party owned, meaning they will charge your franchising fees, your management fees, and of course a percentage of turnover from these assets that do not belong to them. Yeah, so that's a summary of how these fees are generated. So I have another question asking about Sanders REIT. I'll take this question. This will be my last question before I hand the time over first. So for Sanders REIT, they didn't provide. There wasn't a call this time around. It was just the slides that were presented. So for overall, I think their business is relatively resilient. Slight decline in occupancy, I believe. Just give me a second to pull it up. Okay. Maybe I'll take this question slightly later on. I'll hand the time over first. Let me try to pull up my notes.
Okay, thanks, Natalie. I'll take the questions on the banks. So I think the first one would be UOB. What is CIR? CIR stands for the cost to income ratio. And the 9-month 2021 CIR is currently at 43.8%. And management's guidance is around 44%, which matches our estimates of the 44% as well. And next question, if you can only choose one local bank to invest, which one will you choose and what is the reason? Personally, I would say it's DBS, as mentioned earlier, because of their a lot of GP writebacks, which increased their earnings, and also their business momentum is quite strong. Also, their loan under moratorium remains very low at 0.5% of their total loans. And lastly, the management did mention about their upside from higher rates, where 10 basis points rise in interest rates could raise their profit before tax by 18 million to 20 million. So if we assume 2 rate hikes of about 50 basis points, the full year 2022 PBT can climb about 1 billion, or this represents 14%. Okay. Next question. Okay, it's quite a long one. Hi, are there any views or concern over the profile of board members at UOB in the near to mid-term, as this bank seems to have more board members who are not experienced in financial industry? For example, its new chairman is purely a public servant with no experience in real business. I don't think I can really answer this, but this chairman, I think, is an independent chairman, so their main key person would still be Wee Cheong, and of course their Wee Choi is also still at the helm, so I don't think it will really change much. These two of them will still be, the father and son will still be at the helm of the company. Okay, next one is Glenn. What is PPOP as in OCBC? So PPOP, I think you're referring to the pre-provision operating profit. So for the 9-month 21 is 5.2 billion, and the third quarter 21 is at 1.58 billion. And this is for OCBC. Okay, next question. What is the real estate exposure in UOB and OCBC, and any to Evergrande or any defaulted Chinese real estate firms? So for UOB's exposure, they didn't explicitly say, but they did mention that it's mainly domestic and policy banks, top-tier SOEs, state-owned enterprises, as well as the large local corporates and foreign investment enterprises. So the NPL ratio for their non-bank mainland China loans is stable at 0.3%. For OCBC, they did mention that less than 1/3 of their mainland China and onshore exposure, is this about 2 billion Singapore dollars, are corporate real estate loans. However, it's largely lending to the bank's network customer. And also their NPL ratio for this non-bank mainland China loans has also lowered to 0.3% from 0.5% in the previous quarter. Okay. The next question, I think it's the last question for me. On OCBC's exposure in China is a related question. What is the value of the 11% of the group loans, and what are the main sectors that the loans are made to? So the value of the 11% of their loans to ex-China is about $32 billion Singapore dollars. And they never mentioned the main sectors, but they did say that the customers include, similar to UOB, is mainly state-owned enterprises, large local corporates, as well as the OCBC's network customers. So I think that's all I have. Scroll through. Okay, I think I'll just hand it over to my colleagues. Thank you.
Vivian, is there anything that for you?
Oh, sorry. Sorry, Paul. I think I got one more question. Yeah, I missed it. So what is the reason for OCBC still underperforming versus other local banks in the new quarter result? So I think, as mentioned earlier during my slides in the morning, slides earlier, was that their NIM declined by 6 basis points quarter on quarter. And this was also mainly due to the classification of loans to NPL from the downgrades of their secured consumer loans in Malaysia, and as well as the increase in Malaysia's relief loans to 4 billion Singapore dollars in the third quarter 21, compared to their 1.5 billion Sing dollars in the previous quarter. So this actually represents 19% of Malaysia's total loans. Also, another factor that is affecting them would be that their non-performing assets rose 4% quarter on quarter. And this is also related back to the Malaysia, where it's due to the NPA formation of new NPA formation of 804 million Sing dollars, mainly from the downgrades of secured consumer loans in Malaysia. So that's one of the main factors why it is underperformed. Okay, I think that's all for me.
Glenn, can you just stay on first? Let me just handle this question first. What is your forecast of interest rates for the next 6 months? What is the rationale for a forecast? What will be the range? Will be the range of impact on bonds? So we don't have an economist because we didn't want to waste a cost on an additional headcount. But anyway, we don't have an official forecast. But Glenn, maybe you can share maybe what is our NIM. I don't think we are factoring a huge jump in interest rates. Can you just maybe just a rough idea what is the NIM expansion you're expecting from the banks? Maybe that is an indirect way to help the attendee here.
Okay, give me a minute. Trying to find that.
Okay, yeah. I think we don't give official, but I don't think we're factoring the banks we're not factoring quite a huge jump in NIMs. So there is upside to that. Yeah. As I just run through, we wait for Glenn. Micromechanics is now XD. What's the outlook? FATA. We dropped coverage on micromechanics, but this quarter, the September quarter was affected by disruptions. And even to the tail end of September, they mentioned, I mean, this is from the results, there was no briefing. They mentioned the electricity curtailment in China is also starting to affect them. So I think maybe this quarter was a bit slower because of the shutdown in Malaysia and so forth. Yeah, but the outlook should be good because what we think is the US operations is making huge headway in the front end, and because there's such a shortage of everyone's trying to ramp up foundry capacity, so they should be a big beneficiary of that, and that's a completely new business for them. Yeah. Thanks. Okay, let me just Glenn, you want to thanks.
We're talking about the assuming the NIM increase, right?
Yeah, what are you factoring the NIM increase at least for the three banks? Just a range and like how many basis points? Okay, let me just take on the next verse. Q&M and Raffles. Do you have to answer? Yeah.
You go ahead first. You go ahead.
Oh, okay. Q&M and Raffles Medical outlook. Thanks. For Raffles Medical, for Q&M, I think for this quarter, we think it should be another healthy quarter. What we are looking at is how fast are they growing their dental clinics. And for us, that is, as highlighted before, that is very core. And I think even though the headlines might be strong, because I think the PCR test is going to be really strong. I mean, we can see the cases here, but I just worry the market will look past that. Because the market might consider the PCR test as almost like a one-off. So I think the focus should be more on the dental and especially the rollout of new clinics. Sorry for that. In terms of Raffles Medical, we are a bit concerned because as the pandemic moves, as the pandemic wanes, how are they going to transition? I think for us, it's just that you have to transition as you lose some of the government revenue, then you have to transition in some of the medical tourism coming in. So at best, I think earnings could be flat, I think for next year, our thoughts. But ultimately, this stock is how well they do in China. Because they have 2 hospitals there, and China is the place. I mean, you talk about aging demographics from the top down. I think that's the best place to be, I guess, if you want to set up a hospital. One of the highest aging demographics, the largest population and rising wealth. So that is the place. But again, the mechanics to get it right, because when you set up a new hospital, number one, it takes gestation period. You are lucky like 4 to 5 years to turn it around. And also China is unique. Most of the patients like to go to the huge hospitals because they see it as where the best facilities, the best doctors, and these are all in the public sector. So again, you just need some time for them to transition away from that. Yeah, but I guess they are in the right place because it's the best market to be. Yeah. Okay.
Okay. I can take on the NIM question.
Okay.
So yeah, for the NIM, well, our estimates are quite closely pegged to the banks, all the banks' guidance. So for DBS, their guidance for the NIM would be about 1.45 to 1.5%, and we estimated about 1.47%. So for UOB, they estimate their guidance would be stable at 1.56%, and we also, our estimate is at 1.56%. And lastly, for OCBC, they guided lower at about 1.5 to 1.52%, and our guidance is currently at 1.52%.
You're referring to FY22, right? Just to confirm. Yeah.
So
okay,
FY22 is also quite similar.
Yeah. So basically, we're not taking in much of a huge jump in NIMs. Yeah. And I think most of the banks are guiding it will be a bit back-end loaded. Yeah, because they think that the Fed will only start to move second half. So you only see the benefit of that in the second half. I mean, this is generally speaking. Okay. The next one, for all the target prices shown, what sort of timeline? We are generally doing a 1-year rolling for our target price. Yeah. Natalie, you want to help? You want to have any? You have anything for some of your questions? Let me just run through before we wait for Natalie. Hi, Paul. Back to venture. What's your take on the leadership change? I don't. Yeah, I think it might be a little bit positive. I mean, nothing against NL Wong, but he's still going to be there, and I guess it would. The new CEO has been there for almost 18 years. Number one, so the transition should be smooth, and secondly, at least maybe I'm just theorizing here. Maybe he can spend more time on strategy and outlook, and get less bogged down on the day-to-day activities. And that's what we meant by could be a bit of a positive there. When you look at the curious thing is when you look at the share price of venture, even though results might disappoint, the share price can still hold really well. So curiously, I think if you get one good strong quarter, interestingly, this stock might actually move because the numbers have been quite disappointing the last few quarters, but still the mechanics of if you look at the structure of the share price, it still doesn't really get knocked down, at most just a little bit. So I'm just thinking if you get a good number, I think the share price can move. Again, this is just looking at the share price, just my own thoughts. No change to our fundamental view. Yeah. Okay, let me answer this last time before I hand up to Natalie. PropNext and Apex Realty. I think we shared in a few quarters ago, the volumes are still very strong for the third quarter. I slipped my mind how much is it, but I think could be 20-30% for, I think 20+% volumes across all resale, new homes and HDB. So we think third quarter should still be strong. Resale will be the main growth driver. I think new units, curiously, you might be running short of inventory out there. So I think the numbers should still be strong for the real estate agents. Yeah, I hope that helps. Okay. I think we have to run because we're hitting, but okay, let me just try this. Now that Temasek is offering for SPH, will this bring down capital price? Will this bring the capital share price further down, given no longer viable? Okay, this one we might have to wait for Terence. He's on leave today. Yeah, so we'll try and get back to you. Yeah, thanks. On maybe next week. Natalie, I hand it to you.
Okay, thanks, Paul. Very quickly, I think there are two questions on Mapletree. Mapletree Industrial Trust. The share price fell from $3 to $2.75, and it has not been able to return back to $3. Any view on this stock? What are the reasons for its weakness? Still good to hold. So for Mapletree, there are several points that were pointed out or touched on during the call. I think one of it is that there might be a little bit of margin compression due to slightly higher utilities as well as energy costs. There was a very small amount actually. Another thing is that for the data center expiries that are coming due for the US data centers, I think the outlook, or rather the rental reversion outlook is not very strong. The US market has generally been pretty soft when it comes to the releasing spread. So there might be, while the manager is trying to push for about 2 to 3% kind of rental growth for the data center rents, factoring in the rent-free period and the tenant incentives, there might actually be a little bit of a negative rental reversion on a straight line basis, yeah, so for the data center. So I guess there's a little bit of a negative over there. Apart from that, for their occupancy, which they thankfully did share the breakdown by asset class, portfolio occupancy as a whole did increase very slightly, now currently at 94.3%. However, if we look at the assets individually, we see that business parks, for example, they are still quite, occupancy is still relatively low, 82.6%. And that's and also because the business parks, they are also, as in for the Singapore properties as a whole, the management is actually guiding for very conservative kind of reversions. They are a bit cautious on the outlook, meaning to say that they are still guiding that there might still be pressure on rents, especially for like business parks where some of these users of business parks are using the space for office related purposes, and there's still some downsizing related to the business park space used for office use. Yeah. Now, one example is that, for example, a manufacturing company that may be located, even excluding business parks, even your manufacturing tenants who may be located in your flatter factories, probably they will have pre-COVID, they probably will have a space for office use, but even now, there has been some downsizing, especially with regard to that particular tenant, where they actually reduced their footprint because they were taking their office operations offline, or rather on a remote basis. Yeah, so just a little bit of a cautious rental outlook for Mapletree by the REIT managers.
Yeah, I think we might have to end it. Yeah, Natalie, I think because there's another session later. Yeah. Okay. Sorry everyone, I think we can't answer all the questions because Bayron has another conference later, webinar later. So thanks everyone for your time, and hope to see you next week. So if you do have more questions, just feel free to email us. We'll try our best to reply. Thanks everyone, and take care. Have a good week ahead. Okay, bye-bye.